Hi everybody, welcome to the Finance This Property That podcast. My name is Dion and I am a mortgage planner and finance professional. My goal is to empower financial legacies for generations, and I look to do this by using my over 13 years experience in finance and having special guest speakers like financial planners, accountants, buyer's agents, family lawyers who are experts in their field to provide knowledge and free education. And without further ado, let's get into our episode today. Hey everybody, welcome to today's episode of Finance This Property That. Today is a cool episode because I have got another listener question. So what we're going to cover off today and what they wanted me to answer is, what am I seeing in current clients that are looking to build their investment portfolio, some of the common mistakes that I'm seeing in the structure of their current debt structure, and also how to avoid them. I find that this is probably one of the questions I get asked the most, and since I had three of you ask the same question, I thought I'd give you guys a little bit of insight into what I'm seeing and how we can avoid them and how I take a lens on a few things. So let's get cracking. Let's get into it. So the three common errors that I see, and we'll go into them one by one. Number one is using offsets and redraw facilities incorrectly. And I find a lot of clients are very confused as to how to use them. And in their current setups, thought they had one, but they only have the other. So they thought they had an offset, but they only have a redraw. And that causes a few issues, especially when we're trying to build out a portfolio. The second one is around the actual structure and how to have the correct loans for the correct purpose, and how to really avoid paying more interest than what you should be, and making sure that the products suit the requirements. And the biggest one that I'll cover off, which is the third one, is the importance of planning, not only for now, but what am I going to do 2 or 3 steps down the track? And that really comes down to who you speak to and who's your team. So without further ado, let's get into the first one, because it is the most common one that I see. Offset and redraw facilities just not being optimized and used correctly. So let's just explain what an offset is versus a redraw. So they effectively do the same thing, but they just sit in different places. So a redraw, if you've got a variable loan, you normally will have a redraw facility inside it. So basically, let's take the easiest example. You've got $200,000 loan, and you've got $100,000 in cash. Now, if you put that $100,000 into your redraw, it effectively lowers the home loan balance. That $200,000 will now look like negative $100,000. You'll still pay interest on $100,000, and your repayments will still be on $200,000. So yeah, it's saving you interest. Now, does that work when your next purchase is going to be an investment property? I'm about to get into that in a second. An offset facility is just a normal everyday account that if you put that $100,000 in, your loan balance will still be $200. Your net of offset is $100, so you're still paying interest on whatever's in your loan minus what's in offset. So let's say there's $100, you're paying interest on $100,000. Your repayments are still the same on the loan, which is $200,000. But you're actually paying your loan off quicker. In both scenarios, you're paying your loan off quicker. Now, where the confusion lies in, how do we create, it creates tax complications when you've got money in redraw and then you're going to pull that money out to buy an investment property or to buy another owner-occupied property and make the existing one an investment. Because let's say let's take the most common scenario where you've got your loan, it's currently your owner-occupied property, and you're going to pull that $100,000 out to go buy an investment property, and make the current property an investment. Sorry, you're going to buy another owner-occupied property, and you're going to make your current property an investment. Now, that 100,000, you've got to go back and say, what was the purpose of those funds? Because that's what the taxman's going to ask you. Now, if those purpose of the funds was to go buy an owner-occupied property, but the property that you took the loan that you took the money out of is now an investment loan and it's for an investment property, you can't claim back the full 200,000. You're only going to claim back 100. So this is where you need to speak to a mortgage professional like myself to make sure you've got the correct debt structure to maximize your tax benefits, and also plan for that future, because that's the most important thing is people aren't planning and getting the debt structure correct. So where if that was sitting in an offset facility, your loan amount's still 200,000. That 100,000 is effectively in an account. You take that $100,000, your loan's still 200. The tax deductibility will still be on 200. You've just gone and put a deposit on your owner-occupied property. Go forth and conquer, basically. So there is a little bit more complication to that depending on the scenario, but that's a really basic example which I see quite a bit of. And more recently, one of my clients had a very large sum, had $1 million loan, had $700,000 sitting in Redraw. They thought that they could just pull that money out and go buy an investment property. Mate, like, your accountant's going to find that an absolute nightmare to work out, because you've got owner-occupied and investment debt rolled into one. Basically, what we did was we recycled that debt, made a $300,000 home loan. So now your repayments are on $300,000. We saved them $4,000 a month just in repayments. Recycled that $700,000 out into an investment loan. Parked it made it interest only, parked it in an offset till they were ready to find that property. Therefore, they weren't paying any interest on that $700,000 loan, but they were making less repayments by $4,000 a month on their owner-occupied loan. So, bit of strategy, bit of debt structure, and now that whole $700,000 is tax deductible if they go use it for the purpose of an investment property. So that's common error number one. Number two, not having the correct structure, and therefore you're paying more interest, or you've got the wrong products. So when you come and see a broker, I think the common mistake is people just go to their bank and expect them to have the level of sophistication as a broker would. When you go to a bank, you're only getting one product and one type of policy, whereas if you come to a broker, I can actually, like myself, so I'll be able to plan your mortgage, strategize the debt structure, get the correct policies to suit your requirements, which means that you'll maximize your borrowing capacity, will get the best rates for what you're looking at doing. Therefore, that's going to stop you from overpaying the rates. I go do the shopping for you based on your requirements and objectives, and therefore put it with the lender that best meets those, which is called best interest duties. This actually ends up having significant impact on cash flow, which is number one for your investments. Most clients will want to maximize the tax deductions on their investment and try and pay the non-tax deductible debt, which is normally your owner-occupied property, out quickly, which will therefore increase equity, and we can go again, recycle the debt, go again. Also, a lot of clients ignore they say, oh, look, I don't want 5 loans, but having, 2 or 3 loans with key purposes actually will help you, I guess, partition out where those investments are, where that money's going. And for your accountant, they're going to love you because they can clearly see owner-occupied property, equity loan 1, equity loan 2, and then another investment loan for the purchase. And we like to also structure that out to keep your security separate so that you can have the greatest flexibility as well. And another trap that we're sort of seeing is clients not opening their minds up to potentially looking at fixed rate options to actually, have a better understanding of where their cash is going. Now, fixed versus variable is very dependent on the strategy and structure, and that's why we have that conversation. So How do we get around that? Pretty simple. Let's have a conversation and let's plan that, because the third and most important thing is not actually sitting down with someone like myself, a mortgage planner, and a finance strategist, to figure out, well, what is my long-term goal? You'll find I find a lot of clients just go, actually had one yesterday, just went recently, about 2 months ago, went to their existing broker and just goes, oh yeah, I want to do this, this and this. And as soon as their broker said, oh, you can't afford it, we're just going to refinance you and just restructure the debt, they just took the option and just did it. Now, I've gone into it. I've gone into their current structure and gone, hang on a sec, there is borrowing capacity. If we use this policy here, we can actually leverage off that, because there's a lot of clients that get bonuses. There's a lot of lenders that'll use the most recent year's bonus as well, which actually maximize borrowing capacity. So where that sort of leads us is to plan early, but plan 2 steps down the track. So I always ask the extra question, and I asked 2 or 3 questions, and I actually found out from this client that in 5 years' time, they've already got an investment property that they actually want to move into. They're going to make their current owner-occupied property an investment and then knock down the other investment and rebuild their dream home. Now, how do we strategize for that? That's very individualized, and it takes time. So we need to sit there and plan what's our next 2 to 3 moves. And on top of that, they also want to buy a rooming house or build a rooming house. So it's very key that that rooming house is structured correctly in the right structure, because currently all their debts in their personal names. I've sent them to get some advice around structuring the next property to protect their assets, but also increase their borrowing capacity as well. Now, that could be purchasing it in a trust structure. That'll be up to what the accountant advises. So overall, what I am actually saying here is speak to a professional that is not linked to a bank, i.e. myself, a mortgage planner and finance strategist that will be able to guide you through not making those mistakes when you're looking to grow your portfolio. The structure is so key, and having someone that understands your structure and can keep moving you forward rather than backwards is so important. So, guys, I hope you got something out of that today. It is a question. Those questions I do get asked a lot, and I do see the same thing happening over and over again. You guys are really good at what you do. I'm good at what I do. So I always say seek the advice of people that understand what you're trying to do, and we'll be able to challenge you and ask the question. So if you found something very useful here, or you know of someone in the same position, share the podcast, share the little notes. It's free. It doesn't cost you anything to share it. It's also supporting small business. You can find me on Instagram at Dion Finance Specialist. You can find this podcast on Instagram as well. All the little shorts are there at Finance This Property That Podcast. The full episodes are on YouTube, Apple and Spotify if you just want to listen to them. But if you have any questions, shoot them through. Happy to take them out on the podcast and discuss them and flesh them out further. But want to display a bit of a disclaimer here, guys. The advice I gave these clients are specific to their needs and requirements. The information on this podcast is general in nature, doesn't take into consideration your personal circumstances. If you'd like to know more, come and have a chat. Doesn't cost you anything, and we can see how I can best support you in your journey to financial freedom and financial wealth. Have a good day, and see you guys on the next episode.